Hi everyone, I'm back. I've had to take some time and regroup and decide what exactly I would be presenting to you on a periodic, regular basis. Um, I think the market updates were fine and economic updates were fine, but I think it needed structure. And I needed to think about what it is that I was doing for you. A huge part of it is education, of course. A huge part of it is sharing my opinions with you, and they are opinions. Um, but a lot of it is trying to calm everybody down. As we saw in the last, several weeks since the beginning of March, headlines can really take us to different places. Um, Headlines are one thing, news is one thing, and reality is another. And I think we have to distinguish these two things in order to make sure that it doesn't really filter into our lives in a negative way. And so I think that was my desire in starting this, and I would like for that desire to be a little bit more present. And I hope that you understand what I'm trying to do so that when you do open these videos and start watching, you know what my intentions are, and then you can understand the angle here. So, with that, I've also decided to rebrand these videos. The chamber music mindset it still means a great deal to me because I love chamber music, but not everyone knows what chamber music is and also why I named it the chamber music mindset. Um, it's a very, very intimate form of music, but I don't think it was coming across. So I am changing the brand to In Tune, a market note. And it still has a musician angle to it, but at least you know what this thing is about. That it's not about chamber music, it is actually about the markets. And we're trying to tune it so that it matters in our lives in a relevant way. All right, so with that explanation, we'll get started. Okay, so let's get caught up. Um, I think the last time I posted was maybe end of January. A lot has happened since then. Let's just do a recap of what we've seen in the last 6 weeks or so, especially after the war began. Before the war, the markets were a little wobbly, but it was very selective. So if you were invested in what we call value sectors, so things like utilities, consumer staples, which are just like grocery stores, some of these more stable companies were doing fine. In fact, they were outperforming some of the more, uh, high flying tech names. So, and that's something we call rotation. So sometimes tech and growthy names will do better than some of these, steady eddies. And that has been the case for many years. And then sometimes, tech gets or growth stocks get really expensive and value stocks are not as expensive. So investors tend to rotate. So that's kind of what we were seeing happening. And that's normal. We just call it a rotation. But behind it was two things that were driving some of the sell offs. One was just investors balking at the amount of money that was going into AI development from the Magnificent Seven names, namely the hyperscalers. So we're talking about $650 billion of investment into AI just in the year of 2026. That's not pocket change, right? And investors are not necessarily used to that kind of a ticket price in something going into just one endeavor after years of billions of dollars already going into it, right? So there was a sell off in some of these hyperscalers. And also, there was something that the markets were calling SaaS apocalypse. This is software as a service apocalypse, meaning with AI development, especially agentic AI coming in line. And Claude, Anthropic's Claude, showing capabilities in agentic AI that that you and I could actually use on the user end side. And so there was a big question mark in the markets about the viability of the existing software enterprise software companies. So there was a huge sell off in those companies as well. Um, I won't go into that right now because I'm just trying to do a huge overview. I do think that it was overdone. I think that it's something we need to pay attention to for sure. But, for a lot of these companies to be sold off in 20-30% from their recent peak is a little bit overdone. It was definitely a sell now and think later kind of an environment. And that was the environment in which we found ourselves in this military. Some would call it, an excursion, some would call it a war in Iran, right, overnight. And what happened was, if we think about the whole period, it was a period in which what I call like correlation going to one. I'm sure I've mentioned this before. Um, Equity markets responded to oil markets. So oil prices go up because the Strait of Hormuz is pretty much shut. Equity markets go down. So every time this was happening in tandem together. Same thing with the treasury markets. So the 10-year yield would go up with the oil prices because of fear of inflation, oil prices causing inflation. And then, of course, when yields go up in the bond market, it means the prices were going down. So stocks and bonds were losing together. Terrible for diversified portfolios that many of us out there have, right? So it was a really difficult time, not only psychologically, because all of this destruction doesn't feel good, and you worry, anxiety levels go up, right? But also, if you are an investor, it was just a difficult time. I hope you were not looking at your portfolios. And that is something that we, and many of us in the industry, recommend is that do not look at portfolios during periods of volatility because the best practice is, especially if you're a long-term investor, is to write it out. And what happened was near the end of March, we did see the equity markets kind of find a little bit of a support from the bottom. And then since then, a lot of things have happened. There was sort of an ultimatum that got pushed out because of a talk of a ceasefire, right? Very, very wobbly as well. But that's when the market sort of seems to have found its bottom and it's starting to head back up. Who knows what will happen? Nobody really knows. And that's another thing about headlines is that everyone suddenly became a war expert. Everyone suddenly became an expert in this and that. And they are experts. I'm not saying that they're not experts, but they all have different opinions. And depending on who you listen to, your anxiety levels can go up or down. And from my experience, it's just nothing but going up. And that's not good for you. That's not good for me. That's not good for our mental health. It's definitely not good for people who are prone to making decisions based on how they feel. And this is, we know from, many, many studies that behavioral biases are definitely real in investing. So that's why, I tell people don't look at it. Don't look at your account when things are rough because you might be compelled to do something you really shouldn't, like get out of the market. Right? If you got out of the market, would you have known to get in before March 30th? The answer is probably no. Right? So this is all to say the diet of headlines and news should be in moderation. We need to know what's going on, but don't read it so much or listen to it so much to the point where you are, the anxiety level is high enough for you to act on impulse. Right? That is not good for your portfolio. That's not good for you. That's not good for any of us. Right? So that is all about the markets. I'm going to talk about for the rest of the video what I think the world looks like going forward. And what's behind us is behind us. I just went over it. What does the rest of the year look like potentially? All of this is, intelligent speculation. Again, no one knows what will happen. No one has a crystal ball, but it doesn't hurt for us to sort of consider different potential scenarios. So that's coming up. Okay, well, let's talk about different types of scenarios that we might expect. The question really is, what will happen to oil prices? A lot of us are wondering what will happen to interest rates, inflation, and ultimately people are asking me, will this lead into a recession? I've seen some headlines about stagflation, all sorts of different potentialities. So let's tackle that one at a time. Okay. So a lot of what may happen in the future will depend on price of oil. This war was highly impactful event because the Strait of Hormuz actually is responsible for the transport of about 20, maybe over 20% of world's crude oil supply. And we're not at a point, the world is not at a point where the renewable energy is so robust and powerful that it can actually replace crude oil. And we will not be there for a very, very long time, if ever. I'm not sure. So let's talk about oil. There were two issues with oil. One was originally when the war started, it was really about the blockade, right? So all these ships were waiting to cross and they're just kind of sitting there. The supply is there, it just can't move, right? So technically, if you reopened the Strait of Hormuz and the ships were able to go through, we suddenly have supply that's available to different areas of the world, and oil prices presumably would go down to where it was before. But in the middle of the war, we saw a change, which is that the Iranian missiles were bombing certain oil facilities, right? Liquefied natural gas export facilities in Qatar, as well as crude oil production facilities. Now, in production facilities, these actual facilities are bombed and they're damaged, then the actual supply matters, right? It actually, you can't produce as much. In fact, earlier this week, Exxon came out and said 6% of the production facility or capacity has been destroyed, and it will take a long time for that to come back in line, right? So this is no longer about, yeah, we still have the same amount of oil, it just has to move. Now it's about, yeah, we can move that oil to where it needs to go. But after that, what happens? We have a shortage, right? So this is where I think, all things being equal, the oil price will not go down immediately where it was before the war, because there's now a real shortage, a physical shortage. Even if the Strait of Hormuz were to open completely and it goes back to where it was before, which right now it looks kind of questionable, right? It's not going to go back down until we have some kind of a relief on the supply side. That is, unless the world goes into a situation where the demand itself goes down as well. And that's not a good situation. That's more of a recessionary situation. And why do I say that? The United States, we have our own oil supply. So in terms of actual, shortage or surplus, that's not going to impact us. You're going to be able to get oil if you go to the pump. Even if it's more expensive than you would like it, you're going to be able to get it. But actual, physical oil being available in other areas of the world, that's a different story. So Europe and Japan and South Korea, Asia, these places really rely heavily on other countries. So let's take Asia, for example, because I think that's where it is mostly hit the hardest. A lot of their oil imports come from the Middle East, right? And it's really the Middle Eastern facilities that have been bombed and destroyed. So that's going to be very expensive over there. Not only that, but there would be a shortage. And that could cause a lot of problems for those countries. It's just not the same over here in the US. We're going to see higher prices, but in terms of actual physical supply, we have plenty of it. And that's when President Trump says we have a lot of oil. It's true. We do. It's here in the United States. So that's on oil. Now, depending on how high these prices stay up, so how long it's sustained, it can have a lot of different impact on your wallet, your the availability of your disposable income to be able to spend on other things, and that could have knock-on effect for certain retail-based companies that are trying to sell to you, but you just don't have as many dollars than before, right? And that really hits at the affordability issue that we've been talking about. And affordability is a big issue, especially when it comes to homes and cars. And now we're talking about oil. So it really depends on how long this is sustained. Coming into April, we had these numbers come out this past week. retail sales was very, very poor for January and February. So apparently we're nervous about spending. And so the affordability issue being an issue is correct. GDP was revised downward for the fourth quarter. So even though we thought it was relatively strong, it wasn't as strong as we thought. Okay. And then, of course, Friday, this is Sunday, Friday, University of Michigan consumer sentiment came out for the month of April, March surveys, and it didn't look good. It hit all-time lows. I mean, all-time lows of the history of the University of Michigan Consumer Sentiment Index. And the culprit really was the war. It was oil prices. Inflation expectations went up almost an entire percentage point to 4.8% for the coming year. That's high. That's really high. We really need to see that go down, because if you expect inflation to be high, you're going to spend more today. You're going to buy something today rather than tomorrow. And that, again, eats into your disposable income for other things, right? So there's a little bit of a knock-on effect from all of these oil prices impacting your psychology and your sentiment, and then that impacting your behavior as well. So there's a lot of things that oil prices can impact. The other thing is, how will this affect the Fed? Okay, because we're talking about high prices that goes into the inflation part of things. It can impact employers hiring because it'll impact the cost of goods sold or cost that's going into the business. There are many, many different ways in which these things can impact how the Fed is looking at the economy. So remember, the Fed is looking at two things. They have a dual mandate. One is full employment. Labor markets have been kind of stalled. I know we've had 2 months of pretty good labor market reports, but again, it's 2 months. Okay, 2 points make a line. I get it, but coming into it, we were seeing some stagnation in the labor market of low fire, low hire type of an environment. So we're going to have to see some proof of that actually breaking for us to feel comfortable. The other thing is the price stability is what the Fed is looking at, and that's the inflation portion of it. Just a few months of high oil prices is not going to make or break inflation. It's just not. If it's sustained over a long period of time, then it will seep into the economy. So the CPI, they came out, it didn't look too bad. If there was no news in there, and it came out on Thursday, or no, it came out Friday. But again, if it's sustained, we might see inflation being stickier than we would like it to be, and certainly not heading in the right direction toward 2%, which is what the Fed is looking for. So the Fed is watching these things very carefully. It is right for the Fed to not to react to these things. The markets will price in whatever it prices in, but the Fed is patient. It's looking at trends rather than individual data points. But it doesn't mean that it won't impact what the Fed is looking at. So to round all this up, it all depends on how long oil prices stay up, how long it's sustained. Because if it's sustained for a long time, there would be knock-on effects on the consumer side, on your wallets, as well as what the Fed is looking at in terms of inflation. If this is resolved soon in terms of Strait of Hormuz, and it goes down to a reasonable level, maybe not down to where it was before the war, but down to a more reasonable level, I think we could safely call that transitory, which I know is it's a very bad word in recent history and recent memory. But I don't really see it sticking and making its way into the rest of the economy. So that's it for now. That is us basically getting caught up. Thank you so much for watching. I hope to do this regularly. May not be weekly, because on a weekly basis, there isn't too much news. But maybe every 2 weeks, or whenever there is a big event to report on, I will be back on. So that is In Tune, a market note with me, Anna Rathbun from Granadilla Advisory. Stay tuned, and we'll see you next time.